From New York City for our viewers worldwide, I'm Katie Greifeld. Bloomberg Real Yield starts right now. Coming up, just one more inflation print to go as we count down to the Fed's meeting next week, with the bulls still in charge when it comes to the credit markets. We begin with the big issue, rethinking the pause.
The Fed is behind us.
There's a larger framing issue that is not being looked at.
2 additional rate hikes.
Maybe they hike once more.
We need to acknowledge higher for longer.
Maybe they hike twice more.
I think they're going to correct yet again.
The data as it stands really point to continued Fed rate hikes.
The Fed's only going to cut if they need to.
We do think something else will break between now and year end.
Certainly we are seeing evidence that past hikes are working on at least parts of the economy.
There's a lot of confusion in the markets.
The most likely path is that the Fed will keep on pushing back to 2%.
The economy actually in the US remains on a very robust footing.
I tend to think that the economy is far more resilient, as you know, than is appreciated.
Tuesday, Wednesday is going to be probably the most interesting 36 hours that we've seen for a long time.
Joining us now, Quincy Krosby of LPL Financial and RBC's Blake Gwinn. Blake, I want to start with you because we had Canada and we had Australia really set the scene with surprise rate hikes. Does the Fed follow their lead next week?
Not as much as I think people like to think. I get a lot of questions about that. A lot of times when we get surprises at some of these other central banks, people will think that holds some kind of cue for the Fed. That could come in one of two ways. One, I think, is that some people see that as providing cover to the Fed, that if other central banks are doing it, they may follow suit. But also, I think, that to some degree, there's this relationship between other central banks that works through kind of currency mechanism. But for the Fed, that's much less stronger. I think, banks like the BOC have to react more strongly to the Fed. RBA has to react more strongly to what the Fed does. But in reverse, it doesn't really work the same way. The Fed doesn't have to react as strongly to these other central banks, given that we don't have that strong currency channel for the policy transmission. So I don't think that those things are really teeing up a Fed hike. And indeed, you didn't see pricing move that much following those surprises.
Well, just to finish that thought, okay, so maybe we get a hold next week. Does this tightening cycle have more juice in it, or do you think that that's it?
No, I think it does. We actually, after I talked to you a few weeks ago, we actually updated our Fed call. We added a hike to June or July with a preference for July. I think with the Fed speak, we got into the blackout period. It does seem like this time is going to be the pause, and then we're really looking at some tee up of the July hike in the meeting. So kind of a hawkish pause, if you will. So we still see that, have something coming in July. And I would say looking beyond that, with the Fed in very, very data dependent mode, with a lot of data between now and the September meeting, we're very hesitant to add in more hikes beyond that. But I will say I'm much more concerned now with the risks that they do have to hike again, rather than the risks of a hard landing or the wheels coming off and these very deep cutting type of scenarios that I think the markets have been looking at since the SVB stress several months ago.
Well, we're going to talk about recession calls, but Quincy, I want to get your read here. Do you think that we're entering sort of a stop and start Fed tightening cycle, or do you think that this central bank is done?
No, I don't think they're done. And to use the term stop and start is anathema to Jerome Powell. He has mentioned it so often as a reason that the Fed will need to keep going. He always compares that to the 1970s that led to the stagflation and the Volcker aggressive monetary campaign. So I think it's a skip. I think there's a reason they use the term skip. I don't want to be too obsessive about Fed speak, but the pause moved and the skip came in. And the skip insinuates that the Fed is still in the lane for another rate hike if need be. And that would come most likely at the end of July at the Fed meeting.
So we're in agreement that, there's probably more hikes to come from the Fed, maybe not next week. Let's see if we can enter into a little debate here, because there's definitely a debate when it comes to whether the U.S. economy ultimately does enter recession. We heard from Katie Koch of TCW at Bloomberg's Invest Summit earlier this week. Let's take a listen.
I think there's 100% certainty we're going to have a recession because that's the way the world works. It's just the timing, right? When it happens is the harder thing to call. But at TCW, our view is that we are going to have a medium to hard landing.
So that's one side. And then we have the other side. We heard from Goldman Sachs, their economist team over there. They wrote that we have cut our judgmental probability that the U.S. economy will enter a recession in the next 12 months back to 25%, undoing our upward revision to 35% shortly after the SVB failure. So, Qunicy, between Katie Koch, 100%, and the Goldman view, 25%, where do you fall?
Well, we fall, somewhere in between that. We see probably a mild recession, but pushed out. The Fed funds futures market was having significant rate cuts by the fall. That is not showing up. There's a, chance of a 1 or 2%, or rather 25 and 25 basis points toward the end of the year. The economy has a solid underpinning. Obviously, as the lagged effects come in, we could see more destruction in the labor market. And also, we're watching operating margins on the equity side, because we know that companies are going to cut if they have to deliver shareholder value, and they are being pressured by margins. They will start cutting, and that will be more layoffs. And that cuts consumer spending, and there you move into a recession.
Well, Blake, to Quincy's point that we've really seen some of these recession calls get pushed out, we've also seen rate cut bets get pushed out. So I guess the question I want to ask is, a recession a necessary precondition for the Fed to finally lower rates?
I don't think it is. I mean, I've actually, in our year ahead that we published late last year, we saw kind of a gradual easing of the Fed rate later this year. That really wasn't a hard landing. It wasn't a hard recession. I don't think it necessitated a hard recession. It was really more an adjustment in rates as the balance of risks around the Fed's reaction function started to shift. This last year, they really only had to worry about upside risk to inflation. Our thought that was, if the economy is slowing, not a recession, but if it is slowing down, if we see the unemployment rate starting to rise, inflation, even if it's above target, looks like it's heading back to something closer to target, that would allow the Fed to start kind of preemptively pulling back some of the tightness. Again, not moving into easing, not a sharp cutting cycle, but really just pulling back on the tightness, the tightness that was already provided by the hikes that they've done. So that adjustment process is still something we see, but very much like some of the other people you've been citing, that had to necessarily get pushed out into the future. If we're realistically talking about a June and July hike, they're not going to start that process inside of a 6-month period. So unless the wheels really come off the economy and we hit that very hard landing scenario where the banking system crashes or something like that, there's really it's very difficult to see a cutting process playing out this year.
Well, Blake, just following up on that point, I mean, if they pulled back some of that tightness without necessarily cutting rates, how do they do that? Is that through the balance sheet?
No, I was speaking about that in terms of rates. So, we're talking about 25 basis points every quarter or 25 basis points per meeting, and ending at a level that's still north of what we would consider neutral. So maybe 3% or something. So that's very different to me than a typical cutting cycle where you see very aggressive cuts back down to a level that's below what we would consider neutral. So just kind of differentiating that, but it's all still happening on the rate side. I think the balance sheet side very much in kind of autopilot at this point.
All right, understood. Balance sheet still in autopilot. I want to bring this conversation a little bit cross-asset here because there was a really interesting note out from JP Morgan this week. Analysts there wrote, quote, bond markets are still pricing in a sustained period of elevated volatility, elevated macro uncertainty, while equity markets looked priced for perfection, rather. If equity markets were to price in a rise in inflation vol to levels consistent with what the bond markets appear to price in, this would imply around 20% downside from current levels. So a lot to get through there, Quincy, but basically saying that if the equity markets were on the same page as the bond markets, stocks would fall a lot from here. When you look at those two markets and their relationship to each other, which is right? Do stocks have it right, or is it the bond market?
Well, normally, historically, we will say that the credit markets have it right, but you cannot negate the price action in the market. The one thing where you could possibly say that the equity market has it wrong is that it obviously has been a fairly narrow move higher. Just recently, are we seeing a little bit more breadth in the market? But if it's, if we revert to just 5 or 6 stocks moving the market higher, even higher, you would have to argue that the market is priced for perfection and it doesn't have the underpinning of breadth to bring the market towards another rate hike. Having the generals lead is not healthy, especially generals that have been placed in the long duration area of the equity market.
All right, guys, really great discussion. Appreciate your time on this Friday afternoon. That is Qunicy, Krosby, and Gwinn. Thank you both so much. Up next, it's the auction block. Regional banks return to help drive U.S. issuance this week. That's next. This is Real Yield on Bloomberg. I'm Katie Greifeld. This is Bloomberg Real Yield. Time now for the auction block, where we take a trip around the world this week. Let's start in Asia, where corporates raised more than $8 billion so far in June, the strongest start to a month since March. The large majority of that issuance came from banks. Banks were also a factor in Europe. You had names like Lloyd's help to drive sales to the fourth busiest week this year, with more than 65 billion in euros of issuance. And in the U.S., high yield slowed down a bit, but IG remained hot. There was over $48 billion in fresh debt this week, which doubled estimates as regional banks like PNC and U.S. Bancorp had sales. Meanwhile, Chanel Desai of Franklin Templeton Fixed Income says that current market conditions create the need for more scrutiny.
If I look at the high yield market, I continue to see a little bit of cognitive dissonance between what the market anticipates based on the shape of the yield curve in terms of economic activity and the tightness of spreads in the high yield space, for example. Doesn't mean we don't find value. We do, but we're being very, very selective security by security.
Joining us now, we have Matt Toms of Voya Global and Lotfi Karoui of Goldman Sachs. And Lotfi, when I heard cognitive dissonance, I felt a little bit vindicated because I've been looking at high yield spreads currently around 430 basis points compared to all of these recession calls that we continue to hear. When you think about the rally, the resilience that we've seen in the junk market, how sustainable is that?
I think as long as the prospects of a soft landing remain solid, and I think that will probably be the case, spreads will likely remain around their current levels. I don't think there's necessarily any disconnect between current spread levels and the reality of macro fundamentals. The inversion of the yield curve is creating some competition for high quality spread products like IG, for example. But if you look at where the IG index is today, it actually barely offers any yield pickup relative to 3-month Treasury bills. And so if you're unconstrained and if IG is where you need to go, you basically incentivize to find better alternatives. But in high yield, I don't think we have any of those constraints. And so to me, spreads are roughly what they're supposed to be given the forward path of the economic cycle.
Matt, do you agree? Do you see any disconnect here between the fundamentals of what's going on in the economy and what we're seeing in the credit markets, particularly in high yield?
Within high yield and by extension, the bank loan market, I think we are seeing expectations of softening economic growth. But again, the forward curve with a 3.5% Treasury or 3.74 today, we're not really anticipating a dramatic slowdown. So we look at spreads as high yield as having retraced roughly 74% of the recent widening, but investment grade only retracing about half. And so A, there's not a severe economic downside, and B, the dislocation is more on the bank loan side and on the CLO creation side, which is creating some indigestion. But we would think of actually the investment grade market looking cheaper, poised to rally in an up in quality trade as you get closer to the potential for economic growth to slow into 2024.
Well, let's go from spreads to talking about yields, because we had a really interesting soundbite from Mark Kiesel. He is PIMCO's CIO for global credit, speaking earlier to Jonathan Farrow. Let's take a listen.
We think you can get equity-like returns in bonds. The long-term equity return over 50 years is 6 to 7%. We think we can get an equity return. We haven't seen this return potential in bonds in 14 years. When you look at nominal and real yields, high-quality bonds can deliver equity returns with half to third the volatility. So this is as exciting as we've seen it in almost 14 years, and we don't think these yields will be here a year from now.
We don't think these yields will be here a year from now. Lotfi, if you're looking at the economic fundamentals, you think they look pretty good here. Is now the time to buy bonds before those yields do come down?
I think if you're taking a long-term view, absolutely. You look, yields are significantly higher today than they were a year ago, and so you probably have the best level of yield support you've had in 14 years. And then rates volatility, has been on this declining path. And so you have better carry, lower volatility. And assuming the cycle survives the meaningful dose of tightening that has been injected the last couple of quarters, I think spreads should remain well behaved. And so you have range-bound spreads, much higher carry, lower volatility. That should bode very well for the forward path of total returns, whether you look at high yield or IG.
I wanted to talk about that, either high yield or IG. When it comes to that call, I mean, is that sort of a blanket recommendation, or where would you stay away from right now, Lotfi?
I think if I had to take a tactical view, we actually prefer double Bs relative to triple Bs. We don't like the fact that currently, at least, the IG market doesn't offer any yield pickup relative to cash. And so if we're forced to stay sort of within, high quality spread products, I think there's better value actually in agency MBS. That's an asset class that you don't have to take a lot of credit risk. In fact, you're not taking any credit risk. It's just about prepayment risk. AAA tranches on structured products offer better value than IG. So I'm not particularly nervous about IG fundamentals. I think fundamentals look pretty good. But from a valuation standpoint, there are probably better alternatives within that universe of high quality spread products.
And Matt, weigh in on that. When you're looking at the relative valuations of the different asset classes, IG versus junk, for example, what do you see?
So we see IG offering better long-term value as junk has rallied quite a bit. But I'd agree with Lotfi. There's some real opportunities in the high-quality segments of the securitized market. Volatility is the leading indicator. Volatility is falling, a massive outsized increase in fixed income volatility. That provides opportunity across the securitized space, which has more exposure to volatility than corporate credit. So the high end of the CMBS market, even the high end of the CLO market, are offering distorted spreads higher. And we think that is an extremely attractive opportunity, but an opportunity that is not fleeting, likely to persist through at least the next 3 to 4 quarters. So agreed. But again, the yield levels offered to us with a 1%, 1.5% real yield on the 10-year and fair spreads are attractive across the high quality spectrum. And high yield to us looks like it's rallied quite a bit. We'll see the rally move up in quality.
And to go cross-asset here, Matt, I mean, when you're looking at the credit market versus the sovereign market, for example, when you're looking at treasuries, I mean, where do you think the better opportunity is there?
So the good news in bonds is that there's opportunity in both. We think that the long-term value in bonds, if you assume a 2% inflation rate, 2 to 2.25%, 1.5% real, you're going to land somewhere in the 3.5 to 4% sovereign rate. That makes sense to us. The opportunity in AAA and vol-related securities is playing out through this quarter and into the rest of the year. But you can make money in both. And some of it's market segmentation. It's great to have cash at 5.25%, but a lot of institutions can't take the uncertainty of that cash. So they're willing to give something to go to 2 years at 470 or out to the 10-year at 370. That is a search for certainty in a world with an uncertain economic outlook. That doesn't go away very quickly. So we think you'll continue to see that inversion of the yield curve. But that doesn't mean yields have to sell off in the long end. There's a search for certainty, and that's being locked in.
A search for certainty in bonds and in everything else. I like that. But Lotfi, I want to go to a note that you put out last week. I thought this was really interesting because in equity markets and in normal life too, all we're talking about is artificial intelligence. And you noted that basically the rally that we've seen in the equity market, when you look at actually the credit market too, you've seen that in some of the technology sector bonds. And you wrote that there is a limit to downside risk for these issuers, given the phenomenally strong balance sheet positions many of these firms enjoy. And of course, the other conversation, Lotfi, in the equity market is how top-heavy it's been, how narrow that rally is. When you look at the breadth of the credit market, does it have that same problem?
No, we don't. Almost by design, we can't have the same level of narrowness of breadth that you're seeing on the equity market. But I'll tell you what. I've actually been quite surprised with the level of sympathy that you've seen in credit markets versus the equity market. I was not expecting to see such a strong relative outperformance of those potential AI winners. I think the longer term story, however, is most likely primarily going to play out in the equity market. At the end of the day, credit is mostly about downside risk as opposed to upside risk. And so to the extent AI is a big productivity shock that could translate into a big boost to earnings, I would view that as a big benefit to the equity market. credit does benefit on the margin because that improves credit quality, all else being equal. But I think it's most likely an equity story first and foremost before being a credit story.
Well, Matt, weigh in on that point. Again, this is the story in the equity market. When you think about what we've seen in the stock market, does that carry through to the credit market? Are you looking at the tech sector when it comes to the debt market and thinking about AI?
We have to be, because you look at the growth multiples, 27 times on the Russell growth and moving down to mid-20s next year. What that's telling you is people still have an uncertainty about where cyclical growth could come from or where mean reversion and financials could come from. And we think that you're beginning to see the broadening of that valuation in equities and into fixed income. And again, that is another proof point of people are looking for certainty because they don't have the economic growth uncertainty that of the forward path. So that's what the equity market's saying. It's idiosyncratic. We tend to think of as downside risk. It's also upside risk, idiosyncratic. And that's what you've been seeing in equity markets, idiosyncratically driven because there's not a strong enough narrative on the macro front.
Guys, great place to end it. Really enjoyed this. That is Matt Toms and Lotfi Karoui. Thank you both so much. Still ahead on this program, though, it's the final spread. The week ahead, all eyes on the Fed's rate decision. That's next. This is Real Yield on Bloomberg. I'm Katie Greifeld. This is Bloomberg Real Yield. Time now for the final spread. The week ahead coming up, the UBS takeover of Credit Suisse could happen as soon as Monday. And then on Tuesday, we'll get U.S. CPI, and Wednesday, PPI, and then the big event is the Fed's rate decision. On Thursday, it's the ECB's turn, and Friday brings the BOJ's policy decision. But U.S. CPI is going to be the one to watch. So let's talk about what the expectations are. It's expected to be a continued disinflation. Inflation expected to continue to cool, but it's this gap that's been opening up between headline and core that I'm really excited to see. As you see, the estimate in May is that gap annually should be over a full percentage point. So we'll keep an eye on it. But from New York, that does it for us. Same time, same place next week. This was Bloomberg Real Yield, and this is Bloomberg.